Hi, it's Charlie giving you Monday's market commentary. So what I've got here is a blank screen because just to start off I just want to pose a question to you. Would you rather be right about the markets, or would you rather be making money in the markets? Now you would say that's a fairly simple answer. You want to be making money. But from a psychological perspective, every trader will, to some degree or another, at least feel the emotion of wanting to be right about their analysis. The problem with that is being right, wanting to be right, means that most traders will opt to take profits too soon. So you may take a profit of 10, take another profit of 10, take another profit of 10, and what it does is it makes you feel good because you're being right about the markets, but your strategy may say actually you should be taking profits at 100, let's say, on each of these trades. You should be taking 100 and then 100 again. But what ultimately happens is it comes back to bite you. So you can merrily go on being right because you're taking your profit so quickly that as soon as a trade gets into profit, or it may not even be a particular trade, it may just be overall. You may have a couple of you keep your stops ultra tight as well, and so it looks like you're making money, but you're making such small amounts that you're not actually getting anywhere, because then you only need to have one day where you have a 100 loser, and that wipes out all of this. So you can be merrily going away saying, "Yeah, I know I'm not making a lot, but I'm profitable." There's what's the old saying? You don't go broke making a profit. Well, that is so wrong, because if you're making too small a profit, then as soon as you have your losing day or losing trade, then it wipes out all of that. Then you're not really getting anywhere. So that's the first thing. So I would certainly encourage you to have a little think about that if that's the way you feel, because if you feel like you're wanting to be right all the time, don't get me wrong, everyone feels it. You want to be right. We want to be right in our analysis in these videos. Of course you do. But the main thing when it comes to trading is not really about being right all the time. It's just about making sure that when you get your opportunities, you can get those bigger trades off, those bigger runners, which don't come along all of the time. But what these ones do is actually, these are the ones that make you the money, not these ones. These ones make you feel good. These are the ones that make you money. Yes, you'll have more losers on this, but relative to your winners, then these are the ones that make you the dosh. Now, talking about being right about the markets, let's actually go into them and see if we can okay, let's start off with the main stock market indexes. Actually, we've got the S&P here. Let's put it on. It'd be useful if I actually put it onto a daily chart. There we go, and just zoom it. There we go, so you can see a little bit more there. And so let's start off by actually putting on. Let's go back a month or so when I warned about the divergence there in the indices. And so let's have a look. Go into comparisons. Let's put the T2108 on, and then do this. And so what we've got here is the comparison with the stocks trading above their. Oops, there we go. So stocks trading above their 40-day moving averages. Sorry, I had to remind myself which one. Always forget which one, because you've got T2108 and T2107. One's the 200, one's the 40. But as you can see, we had a big divergence here between these two peaks, and so what we had was peak over here, and quite a big divergence, which I warned about on the S&P back then, that we did have that breadth divergence in play. As you can see, it ultimately has played out. It played out at that time, then we bounce, and of course you have to then start to say, okay, well, it's possible we can then now start going up to break to new highs again. But ultimately, that divergence in stock market breadth has obviously just carried on following through, so we can see what's happened there. And so well worth, and I've said it many times before, well worth you periodically having a look at that. It doesn't come into play very often, these divergences with the T2107 and 08 on freestockcharts.com, but well worth having a look at them when you do see a market having had a run for a period in one direction, and then if it then starts coming over and it looks like it's close to double tops or double bottoms, that's when to look at it and see if there's a potential divergence in place there with the actual stocks versus the stock index. So where to now? Now we've got a bit of an inverted hammer here on the S&P, and if I look at the Dow, I think we closed on a doji, so it's possible that we get a bounce. Let's have a look at the Trin. No, the Trin's not closed too badly actually, so it's possible we get a bounce, but it's only on the Dow. But we have got inverted hammers and the likes, and we certainly are into some support. So as we've got the 200-day moving average and prior highs and such like there, so it's well worth obviously having a look for that. But ultimately, at the moment, until proven otherwise, it suggests that these markets may have some more downside. So if they are going to have some more downside, where may that come into play? And I would again suggest we go back out to looking at prior highs and such like. So where do we go to from here? Because we tested these prior highs back earlier on this year, and so obviously this low now becomes very important, but that's a long way off yet, so it's too far off for us at the moment. So let's go back down to the daily chart, scroll out and say, okay, well where on the daily chart could we find support? And the problem we have currently is that we've got, if I put these on, we've got support zone there, and then we've got support zone down here, and we've got this one in the middle as well. So basically we've got a whole cluster of support that the S&P is coming into right now. So anywhere from here where we currently are down to around about looks like around about 1365 area, so not too far from where we are. So we're there or thereabouts into a big zone of potential buying support. So before we get a bit of a bounce, but ultimately at the moment we're making lower highs, lower lows until we break that sequence of lower highs, lower lows. Then at the moment the trend is going to be, the short-term trend is down, which means that we'd need to break above these highs up here in order to eradicate that. So for now, any bounces should be seen as just that, and they're a bounce within a short-term downwards trend until proven otherwise. Let's have a look at a couple of the currencies. So first let's have a look at the euro, and again euro's just been very, very steady Eddie really. It was in this trading range. Again, if I bring the box up, then it was in this range here, and it's only just broken out of it at the end of last week. But again, same with the euro, it keeps on hitting supports with 200-day moving averages and things like that, and but it's coming down, and so again with the euro we've now got a significant close below 127.50, and so we should be looking for potentially more downside. So again, any rallies, any bounces in euro, ultimately we should be looking at as potential shorts, shorting opportunities until proven otherwise, which means that really would need to come up above these highs up here. So for now, euro is pretty weak, and it's going to be the same with the pound as well. Pounds had a nice flush down. No reason to think that this can't continue, but again, pounds coming down into prior supports zones, so we've got to be aware that we could be seeing some bounces, but overall it looks like the short side is dominant at the moment. It's steady Eddie dominant. It's nothing too volatile. It's just steadily creeping its way down. But for now, that is the side of the market where most of the volume is. So how would I be looking to position myself? Well, I'd go out to something like a 4-hour chart and look at the straightforward 50-period moving average. Keep an eye on that. Since we've broke down at the beginning of November on the 4-hour chart, we haven't been back up to test it. So any rallies, I would look at the 50-period moving average on the 4-hour time frame, which is what I've got on at the moment, as an area to look at placing swing shorts in. And it's the same if we look at that's on the euro. If I go back to the pound dollar, similar situation on the pound dollar, hasn't tested that 4-hour 50-period moving average, so I'd look at that as well. So that would be how I would be looking at it if I wanted to look at swing trades, to getting into swing trades on the short side. We go back out to the daily chart and you're thinking, well, I don't know where to get in on that short side at this stage. Well, that's certainly one area that you may want to have a look at. And anyway, I shall leave that with you. Have a great week. Kim will be back in touch on Wednesday.